Hi folks, David Lefevre here with ERISAfire Benefits Compliance Solutions. In this episode of Too Long Didn't Read, we're going to cover ACA 1095 reporting developments. As we head into 1095 season, there are three things employers need to know. Number one, the COVID-19 pandemic will have an impact on 1095 reporting. We'll tell you how. Number two, new federal forms were issued this year, and there's some changes you should know about. Number three, there are additional states requiring 2020 reporting to be provided to those jurisdictions in 2021. Let's start with the first development. Not only has the COVID-19 pandemic affected nearly every aspect of our personal and business lives, it will have an impact on 1095 reporting. Furloughs, temporary layoffs, reductions in hours will all have an effect on the Series 1 and Series 2 coding. Recall that Series 1 codes are those like 1A, 1H, and 1E, about whether or not an offer was made that month. Series 2 codes are things like 2D and 2C that say whether or not, if an offer was not made, why not? And if one was, whether an affordability code applies. In addition to these changes in employment having an effect, the IRS also issued guidance allowing employees to change their medical elections more freely. If employers implemented that advice, you're going to have additional circumstances where the general rules of 1095 coding are not going to apply and exceptions will instead. You're also going to see vastly more break-in service issues. Now, recall under the ACA, it has its own definition of what a full-time employee is and when someone who has been rehired can be considered a new employee versus a continuing employee. It might also be called the 13-week rule. With the economic changes that resulted from the pandemic and our response, you're going to have more rehires than normal, impacting the ACA's 13-week break-in service rules and changing how 1095s are processed. In addition, responding to the economic realities of the pandemic, employers have also changed premiums in some cases. This may come about because a COBRA premium for folks whose hours were reduced was subsidized, or temporarily laid off employees who were rehired had a different COBRA premium, etc. There are several reasons why their premiums might change. That all has to be factored in to 1095s. The second development is that the IRS has issued new forms this year with two additional data fields. One, the employee's work location, and two, the employee's age. The IRS has also created 8 new Series 1 codes, increasing the number of possibilities for what code goes on line 14. Fortunately, both of these things, the 8 new codes and the 2 new data fields, have to do with individual coverage HRAs, or ICRAs, or ICHRAs. While the IRS hasn't issued instructions for the forms yet, we do anticipate that the new employee data fields will not be required. We don't know that for sure, but that is our suspicion. The 8 new series codes very likely will not apply either if an ICRA is not offered. So for employers that do not provide an individual coverage HRA, these new changes won't mean anything. Good news there. If you do offer an individual coverage HRA, ACA reporting got very complicated. The third development this year is that a number of states have added employer reporting requirements for their jurisdictions. We've grouped them into 3 different buckets. The first will require probably slight modification to the 1095 process for various companies. Washington, D.C., New Jersey, and California are the states we put in this class. The reason we did this is because the schematics for these jurisdictions is very similar, not identical in all cases, but very similar to the IRS format, and the data required will come straight out of a 1095. So if modifications have to be made, it is a very slight modification. In the second bucket, we have the jurisdiction of Rhode Island. And for this bucket, we're saying that there is a moderate modification to your 1095 process, potentially more than moderate, because Rhode Island's due date for employer reporting to the state is January 31st. If you file electronically with the IRS, that deadline's not until March 31st. So this pushes up your 1095 reporting deadline much, much sooner, 2 months sooner. In the third bucket, we have Massachusetts and Vermont, and this bucket we're calling no impact because Massachusetts has had employer reporting for quite a while, and the convention is that the TPA for self-insured employers is the one doing this reporting in most cases. And in Vermont, it has an individual mandate, but not an employer reporting requirement yet. Stay tuned for next year. So what does all this mean? First, if you're doing 1095 reporting in-house, this may be the year where it just is no longer worth it to do it in-house. There's just too many complications. Second, it means you're going to have really good rehire data, particularly if you had temporary layoffs where you were rehiring people inside 13 weeks. Normally for rehires, data systems will have a prior or original hire date, a last hire date, that's the most recent one, and a termination date. But this intervening termination date, the one that occurs between the original hire date and the last hire date, is often overwritten in HR information systems. And that date's absolutely crucial for the potentially increased number of rehires that are happening this year because of the pandemic. It also means that you're going to need really good data on mid-year changes. And mid-year changes could happen because of eligibility or elections, or if premiums were changed on account of the pandemic, or if COBRA was subsidized, you're going to have mid-year changes in premiums. That makes things quite complicated from a 1095 production perspective. Ultimately, it means that the software output may need a substantial amount of manual work in order to have confidence in the integrity of the forms that you're producing. So particularly if you're relying on a software forward vendor, or if you're just using software yourself, it may require a lot of manual work. If you're going to have any hope this year of kicking your feet up a little bit in January or February, our recommendation is to find a vendor with a consultative analytical approach. This is the approach ERISAfire takes. We start with reports that you already have from your payroll system and your HR information system, so that you're not spending hours shoehorning that data into a spreadsheet that we need. Instead, we develop custom database scripts for every single client to make sure that the data they provide is processed appropriately. We also use human edge case resolution, meaning that we will use software to do what software does best, which is to follow a strict set of rules. But there are always exceptions, and this year they're going to be more than ever. We use experienced humans to deal with those edge cases, humans who know both 1095 reporting inside and out and know the company. Thanks for your time. That's all for this episode of Too Long Didn't Read.